Abitibi Royalties, what are we? Well, when I joined the company in 2014, I look at most gold mining companies and I never felt that they had a very good business model and they didn't treat their shareholders very fair. When we started off here in 2014, we were 30 cents a share Canadian, and you have to apologize that all these figures are in Canadian dollars because our financials are also in Canadian, so we try to keep it consistent. And during this 4.5-year time span, we've had the best performing gold stock, I would say, in the universe, going from 30 cents to $10. And the question we often get, and I actually had it already today, I wish I would have bought here. Well, I've heard this many, many times during this process. And one thing I really like about the royalty companies is that there's a very good template to follow, and that was Franco-Nevada, who had one great royalty very similar to ourselves. They started off at 30 cents a share, climbed to about 7, and they're at a bit of a similar phase of development that we are today, and then they went from the current price to 40, got taken over by Newmont, re-IPO'd at $15 a share, and now trade closer to $80, $90 a share. So the one thing that the royalty sector does provide is usually very good share appreciation with the cash flows that they can generate. So Franco's a very good template that we're looking to follow. But the other thing we've also tried to infuse into the story is not only the lessons learned from Franco-Nevada, but also Berkshire Hathaway. And you say, well, what can you learn about Berkshire Hathaway that you can apply to the gold mining sector? And we're going to talk a little bit about that as well. So for those that are not familiar with the company, we have a market cap right now of approximately $125 million. We have $32 million in the bank. We are debt-free. We have 27 royalties. But the main one I'm going to talk to you about today is our royalty at the Canadian Malartic mine. And those that are not familiar, this is the largest gold mine in Canada, and it's probably one of the top 10 gold mines in the world. So when you own a royalty, you want to have it on a meaningful mine with strong operators who are going to continue to reinvest in that asset. We are generating cash flow, and we also have a very small share count, 12.5 million shares. And this is not by accident. There's been no rollback in the company's history. We're very much against issuing stock. So with that said, I also want to indicate, if you are a short-term investor, this is not the story for you. If you are a long-term investor and looking for appreciation over long-term, then you probably should consider Abitibi. But if you are very much looking to pay the gold price on a short-term basis, I would recommend not investing in Abitibi. So just some recent highlights. I'll go through this fairly quickly. You may or may not be familiar with La Caisse de Pau. They are one of the largest investors in Canada, if not one of the largest investors in the world. They bought 5% of Abitibi at the end of June, putting in $5 million for 5% of the company. I think a very good endorsement in terms of the valuation of the shares. And then we started to use our cash flow to make other royalty acquisitions outside of our core. One of the keys to our criteria when we're looking at assets to buy, one is we have to pay cash because we're not willing to issue shares. 2, they have to be in politically safe jurisdictions. And 3, there has to be a strong underlying operator who can perform the exploration and the mining development. As we mentioned earlier, we listed on the NASDAQ here, and we are going to be ringing the closing bell later today. So this was really try to attract more U.S. investors. Predominantly, we are Canadian based, and so this was the reason why we are down here today. So just very quickly, looking at the portfolio of assets, there's an old saying in the mining industry, you shouldn't invest anywhere where they don't wear winter jackets. And I think if you look at this map, we generally wear winter jackets in Canada. And the reason why we decided to have Canada as our focus is because often if you're in a foreign jurisdiction, that government can change the rule of law on you very quickly and take away your asset or break your royalty. So we like Canada, we know it, we think we have a competitive advantage, especially in the Abitibi, and this is why you've seen all of our focus stay within one part of the world. We're not looking to compete all over in Africa and South America against our royalty peers. But the main royalty I'll be speaking to you about today is at the Canadian Malartic mine. In terms of share price performance, as I mentioned, 2014 to present, looking at ourselves versus our royalty peers, obviously we've had very good performance during the last 4.5 years. And then year to date, looking at our performance, we're one of, I believe, 7 gold companies that are actually up on the year in a year that gold prices are down about 5%. And then looking at our performance against some of the small to mid-cap gold producers, once again, we've had very good performance against our peer group. And this is what investing in gold mining should be about. It should be about actually making money, not getting diluted, not having to keep reinvesting. We're all about trying to deliver value for our shareholders. And you'll see some of the concrete steps that we've gone through to align ourselves with our shareholders. So it all starts with, I think, a solid foundation of your company. How many times have you invested in a gold mining company and they started, they had 30 million shares outstanding, and before you know it, there's 100 million shares outstanding, and you just keep seeing more and more shares being issued to finance growth, and the share price keeps going down, and you say, well, this isn't a very good equation. This isn't what I signed up for. You are in this to make money. We have 12.5 million shares outstanding, and the reason why this is interesting is that we were recently told of all the mining companies in the world that have a $100 million market cap, we have the smallest number of shares outstanding. So I think that's a pretty big accomplishment. Another thing that we've done is there's been no equity compensation issued in the past 2.5 years in the company. So you're seeing everyone's getting paid in cash and they can use those shares to buy the market, unlike most of the peer group who keeps issuing 10% of their stock every year. The other reason why we don't like equity issues is that when you issue shares, you're essentially selling a part of your company to a stranger. And usually there's a huge cost issuing shares. You look at the discount to market, the warrant, the fees to bankers. Usually you're paying 20 to 30% cost of capital when you issue stock. And when you issue stock options to employees, most mining companies do 10%. You look at the cost and you wonder why most mining stocks don't go up. It's because they issue too many shares and they don't have a regard for their shareholder base. So right now we just renewed our buyback to buy back an additional 600,000 shares, and today we've bought back 160,000 shares at an average cost base of $6.30. So despite having the lowest share count in the mining industry, we continue to buy back our shares, so we're quite unique in that sense. In terms of cash flow, we're generating a little bit of cash flow today. Last year was $2.5 million more or less. This year we're looking at 3 to 3.5 million as we have a new royalty at Canadian Malartic entering production during the fourth quarter. That's the Jeffrey zone. I'll get into a little bit about that. And then next year we're expecting to see this royalty cash flow increase again. But the important point is this cash flow is very much non-core to us. This is not the reason to invest in Abitibi. The two areas that I'm going to be focusing on are Odyssey and East Malartic, and we think when those enter production we're going to see material growth in this free cash flow, and that's the beauty of the royalty model. We don't have any capital expenditures. We don't have to spend on exploration or development of these assets. So this is probably one of my favorite slides in this presentation. This was a drone image taken about 1 year ago today. In the background, you can see the Canadian Malartic mine. So as I said, this is the largest gold mine in Canada. It's producing between 600,000 to 700,000 ounces of gold a year. It would generate cash flow of about $250 million a year, and it's owned by Agnico Eagle Mines and Yamana Gold on a 50% basis. They bought this from Osisko Mining in 2014 for $4.2 billion. Our royalty interest starts approximately in this area here and then continues off to the east. So the reason why I really like this slide because it shows you the advantage of the royalty model. This is called the Trans-Canada Highway. It is being relocated to accommodate the expansion of the pit. To move this highway is $125 million. The exploration that's being performed on our royalty ground this year is approximately $20 million US. The initial ramp to go underground on East Malartic and Odyssey is another $20 million US. And then to sink a shaft to go deeper is projected to be somewhere between $300 to $500 million for the operators. As a royalty company, we put up none of that money, but we get 3% of all the revenue that's produced from this property. So I think it's a very good model, and when you have strong operators who are vested to see this asset grow, I think we're in a very advantageous position. This is looking at a satellite image. Once again, you can see the mine here, open pit. This is the expansion where the highway is being moved. And our two royalties that are coming into production is the Jeffrey zone, which is scheduled to be starting right now, and then the Barnett extension. This is going to drive our cash flow to $4.5 million per year. But again, they're not the key royalties to be focused on for this presentation. Financially, we're quite conservative. We have $32 million in cash and securities. We're debt-free, so we run this like we'd run our own personal balance sheets. In terms of our shareholder makeup, it's quite unique. As I mentioned, Glenn Mullen, who's here with us today, he is chairman and CEO of Golden Valley Mines. Abitibi was spun out of Golden Valley in 2011, and they still own 45%. Rob McEwen, who you may or may not know within the gold mining industry, he was the founder of Goldcorp and who I worked with for approximately 13 years between Goldcorp and McEwen Mining. He's invested about $5 million for 11% of the company. Case DePoe, who I mentioned this summer, put in $5 million for 5%. And then Brad Conacher, who's at the front table here with Richardson GMP and his clients, also owns 5%. So it's a very tight share structure with long-term investors who are more partners in the business than just passive shareholders. And I have to say that each of them has really played a role at different points in time in the company's history to achieve our success. Just looking at this point on the terms of the board ownership. I've been with Abitibi for 4.5 years, and then during that time I put all of my after-tax salary and bonus into the company. So in the past 3.5 months, my ownership in Abitibi has increased by about $1.7 to $1.8 million. And like I said, I keep investing pretty much every week, so I'm not in this to collect a salary for a lifestyle. Everything that I make from the company goes right back into the shares. So I think that's quite unique in the mining sector as well. And as I mentioned also, we have no equity compensation plans in place, which is obviously very similar to Berkshire Hathaway, where they don't issue stock options either. So just talking about the organic growth opportunities, and what I've found in the mining sectors where you make a lot of money is usually where there's a paradigm shift. This was a historical mine, mainly from underground, from 1935 to 1983. 5 million ounces of gold was produced historically. The property then went into bankruptcy before becoming the largest mine in the country, but it was acquired by Osisko Mining for $50,000 out of bankruptcy. And they had a concept that there was a lot more gold of lower grade around the historical mine. They ended up finding an additional 11 million ounces of gold from 2005 to 2011, and then it was subsequently acquired in 2014 for the $4.2 billion by Agnico Eagle and Yamana Gold. The reason why I think this is important is that you're seeing a big shift right now from the open pit to now the underground again. And does this lower grade mineralization continue at depth? And this has been the biggest driver for the share price, has been the discoveries that we're seeing. Right now we're sitting on about 2.6 million ounces of gold within our royalty at Malartic, and it's coming from four predominant areas: Odyssey, the internal zones, East Malartic, and the near pit targets. But I can outline why we believe this is already larger today and why it's going to keep getting larger over the next several years. And that's because there's a number of zones that show to have very good promise to grow. So before I get into that though, this is the Abitibi region here. The Malartic mines in the middle, a number of other mines are owned by Agnico Eagle within the region. And the one thing I find very curious about most industries, including the mining, is that you become CEO because you were a good geologist, you were a good engineer. Very few times you're put in the CEO position because you are a good allocator of capital. And I think that applies to a lot of industries. But that's the predominant role of a CEO. How do you allocate capital? Acquisitions, future royalties. So in the beginning of June, this is what we started with. We had our two main royalties at Canadian Malartic. And I thought, being very opportunistic, for $2 million we were able to substantially increase our holdings within the Abitibi region. And I'll talk about a few of these areas. But the reason why it's also important is that the $2 million is also a tax deduction. You can apply against your future earnings at 30% deduction per year. So it was very tax efficient. And essentially a lot of this area is almost like lottery tickets. But if you have any discovery on them, we expect that we'd have similar value to what's accruing next to Malartic. And this just shows that basically the same map just blowing up. This was our royalties at the beginning of June. So for $1.2 million, we were able to acquire substantial royalty holdings off to the east. This property was acquired by Canadian Malartic in 2016. So the idea is that any success that they would have here would go back to that mill for future processing. So that was one way we were able to increase our resources. This is the Odyssey discovery in red. This blue area which is called the internal zones at Odyssey, has yet to be calculated. And you can see here there's a reasonably good size attached to it that still has to be estimated, put into the resource. But I think it actually gets more exciting, and this is where I think we're going to see an impact on our resources, which tend to get calculated every February. Again, this is Odyssey here in blue, and our resources are in dark blue. But there's been a number of discoveries outside of the resource area that show significant progress. And you can see some of these drill intercepts that have yet to be calculated. I can't give you a hard number, but when I look at gold discoveries in a politically safe jurisdiction with a small share count that doesn't have to raise money, the company that I'm most excited about is Abitibi. That's why I'm involved here. But the thing to really take note is the Nori zone, and this is the one that gets me the most excited. When you look at those drill intercepts and the fact that you're looking at 1.5 grams over 200 plus meters, and we think this zone here could be a game changer in terms of the growth of this deposit. And just sort of a last point, again, this is the Odyssey discovery, the Jeffrey pit where mining is occurring. There's a number of drill holes along strike or to the northwest that have not yet been calculated. So when we look at this royalty and we look at how the share price is growing from the 30 cents to $10, we think that there's still quite material growth left. And Franco-Nevada was a very good example back in the late 80s, early 90s, how you can continue to grow your share price even after a significant run in value. So when you look at the peer group, the question I had at the very beginning of the presentation, how do you value these companies? And is it an art? Is it a science? Well, when I look at it, I look at these companies should be valued based on discounted cash flows. And when we look at this internally, when we look to do the buyback, we look at what are the future cash flows, discount it between 8 to 10% to get your net asset value. And right now we're buying back our shares not because optically it looks good, but because we believe that it's trading at a value that is materially below the net asset value. And so if you look at our royalty peers, they're trading anywhere from 1 times net asset value to 1.7 times net asset value. And the question is, why would a royalty company ever trade at more than their future cash flow? That doesn't seem to make logical sense. Well, the reason why they trade at such high value is that, again, there's no capital requirement. So the people who own these mines are going to keep drilling, keep finding more, and keep generating more cash flow without the royalty companies having to put up another dollar. In terms of where we're trading at today, I do believe we're trading below our net asset value, and this gap is going to close based on 2 things. As the project gets de-risked, so you're going to see cash flows starting here in the 4th quarter. You're going to see underground construction is anticipated this quarter as well. The project's going to get de-risked, which should help close this valuation gap, and the net asset value should keep increasing because the share count is going down and because we believe they're going to find more gold at the project with no expense to ourselves. So I also want to touch upon something else, because in the mining sector it's often said that to grow you have to issue shares. You look at Barrick buying Randgold right now. They're essentially giving up 1/3 of their company to buy Randgold, and it's an all-share deal. And I find that in the mining sector it always reminds me of politics. It's always a yes or no answer. Can we do this? Yes. Can we do it? No. And the mining is, how do you grow? Well, you got to go buy somebody. And I think that's a wrong answer, because most billion-dollar acquisitions in the mining industry have destroyed value for shareholders. Franco-Nevada generated billions in value on a royalty they paid $2 million for. So, and it shows that sometimes buying big is not the answer. I think sometimes it's buying small and being innovative. So one of the things that we did in 2015, when the gold prices were hitting down to $1,100 an ounce, we launched this website called the Abitibi Royalties Search. And we said, if you need money and you have a property that's near an existing mine, we will pay your property taxes for you in exchange for a royalty. And if that property is ever sold, we get 15% of the proceeds. So we've had 135 submissions online. We've bought 18 royalties and paid $200,000 in total. So look at this part of our business as the payday loans of the mining industry. These are essentially lottery tickets. There's a high degree of risk here, but we paid very small sums of capital for properties that all have gold mineralization on them, and they're all near existing mines in Canada. Here's the Goldex mine in Val d'Or. It's operating, I believe, about 200,000 ounces of gold per year. We bought a royalty that's Agnico owns the underlying ground, and you're looking at it's about a mile away. It's good. It's a good lottery ticket. Once again, you're looking at the Malartic mine. We bought a royalty on what they call the Callahan project. Wesdome, which is considered probably the best gold discovery of this year among the junior miners. They have a new high-grade discovery that is now about 500 meters or 800 feet away from the Callahan project, and it's going in our general direction. Again, it's a lottery ticket, but you like to think out your picks as well, and we think that I think this is the sleeper in the portfolio. This is another Agnico legal operation. You're probably seeing a common theme here. We're buying royalties on generally properties that are operated by Agnico legal because we think they're the premier operator. This is their LaRonde operation, and we bought a royalty just to the southeast. But we have ventured outside of Canada one time, and it was in Turkey, and it's not a country that I would look to invest any large sums of capital. But this was a property that's operated by Eldorado Gold. This is the property boundary. This company here called Frontline Gold needed to pay their auditors one year. So for $65,000, we bought a 3% royalty. And you can see here the veins that they're mining are about 600 feet away. The drill holes are about 10 feet away from the property boundary. And when you look at the satellite imagery, there's historical mining that extends over. So like I said, these are long-term prospects, but we're paying very small sums of capital for them. And there's also very tax-efficient reasons to be buying these as well. So we're buying these out of cash flow with no new shares being issued. So this is basically the story. It's pretty straightforward. We've really restrained ourselves in terms of how we respect our shareholders. And I think a lot of that's because each one of us is a large shareholder. And we're trying to do the right thing in terms of growing the company. And I think it's quite unique within the mining space that you will not find another royalty company or another mining company that has this type of exposure to exploration upside, has the cash flow, and also has the financial discipline to go along with it. I know these presentations are typically very boring, so I'm going to cut it at that point and open it up to questions as long as they're not too hard.